Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question where we are identifying the types of errors and also preparing the necessary journal entries to correct these errors. We will also understand how the profit is affected after these errors are corrected. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll go through and explain step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. CJ Limited's financial year ends on 31st of August. Upon examination of its books on 31st of August 2017, the following errors were discovered. So here you can see we have discovered 6 different types of errors, and we are also given the draft profit before the correction of these errors. And the requirement in part A of the question is to prepare the necessary journal entries to correct these errors, and in part B is to identify these errors. So let's go through each of these errors. So starting with the first one. Owner CJ withdrew goods of $190 for his own use. This was not yet recorded in the books. Now, this is pretty straightforward because we have forgotten to record this transaction. Therefore, this easily falls within the criteria of an error of omission. So how do we correct this? So we record this transaction in our books. We understand the goods were withdrawn for personal use. Therefore, we debit the drawings account by $190. So we debit the drawings account by $190 because obviously there has been a reduction in owner's capital or owner's equity. We understand by default when capital account increases, we always credit it. Now that we have withdrawn some inventory for personal use, our capital should go down, and therefore that reduction in owner's equity or capital is reflected through the drawings account. So therefore we are debiting the drawings by $190. Simultaneously, our inventory, which is our current asset in the business, is going down in value. When assets go up, we debit it, and when it goes down, we credit it. Therefore, we are crediting inventory by $190. Now, what is the effect on profit? It is 0 because profit can simply be calculated by taking your revenue and subtracting all the expenses. Now, in this correction, which we have just done, no expense or revenue accounts were affected. Only the asset and equity accounts are affected. The asset account being the inventory account, which went down in value by 190, and the equity account being the drawings account, which also is an increase in drawings, but indirectly it also relates to a reduction in owner's equity. Okay? All right. So therefore, the effect on profit is 0. Let's go to the second error. Cash of $300 received from Lena had been posted to the account of Lena in error. So here you can see that we have made a mistake in terms of recording the cash received in the correct account for the trade receivable. So therefore, we classify this as an error of commission where the same category is involved, but we record it in a different account. Now, the same category we are talking about is the accounts of trade receivable, who are the credit customers of the business. So we received cash from Lena, but we posted it in the account of Lena. So what happened when we made the mistake originally is that we credited the account of Lena after the cash was received. Therefore, as part of a correction, we need to reverse that. So we need to increase the amount that Lena, L-E-N-A, Lena owes us. So therefore, we would be debiting trade receivables, specifically the account of Lena, by $300, and simultaneously, we would credit the account of Lena by $300 because obviously Lena is the customer who had paid us, and therefore Lena's balance should be reflecting that. So what's happening here is that one asset account, which is the account for Lena, is going up, and simultaneously another asset account, which is the account for Lena, is going down. So what's the effect on profit? Again, it is 0 because as we understand, no expense or revenue accounts are affected. Only the accounts for assets are affected, where one current asset was reduced and another current asset was increased. Okay? So now let's move to the third error. Stationery account and discount received account had each been overstated by $200 each. Now, this is what we classify as compensating errors, which means errors that cancel out each other. Why is that so? So stationery account is an expense account. So if we had overstated our expenses by $200 and simultaneously we had overstated our income account, which is the discount received account, by $200, we would have overstated debits and credits, which would have ultimately canceled each other out, right? So therefore, now to simply correct this, we reduce what we had overstated before. Discount received, as we know, is a revenue or income account, which would be credited when it increases. Now that we have to reduce it, we have to do the opposite of credit, which is to debit it. So we would debit the discount received by $200. Simultaneously, expense account of stationery would have originally been overstated by $200, which we would have debited it by extra $200. Now that we have to reduce it, we have to credit the stationery account by $200. Okay? So what's the effect on profit? So we understand that income and expense accounts are in fact affected this time, where when we debit the discount received account, income is actually going down by $200. And when we credit the stationery account, expense is also going down by $200. Therefore, the net effect on profit is zero, and this should always be the case when you are working with compensating errors, okay? So now let's move to the fourth error which we have got. A credit note of $600 received from Sally for damaged goods returned had been entered in the books as $60. Okay. So this type of error, which involves the wrong entry of numbers, is what we classify as an error of original entry, where the original amount, as we understand, was $600, but we ended up recording it for $60, right? Now let's also understand this transaction properly. So based on what we have read through the first few words, where a credit note was received from Sally for damaged goods returned, that means Sally is the issuer of the credit note, which obviously points to the fact that Sally was the credit supplier. Credit note can only be issued by the supplier, okay? That means our business, which is CJ Limited, we are the one that returned the goods or initiated the return, okay? Now, how do we correct this? So we understand that we recorded this transaction at a significantly less amount of $540, which is derived as the difference between the original amount of $600 and the amount we made as a mistake, which is $60. So therefore, the difference would be $540. So what we can do now is in our books, we increase the purchase returns. Purchase returns, when it increases, is credited. So we credit the purchase returns account, which is also known as the return outwards account, by $540. And simultaneously, we debit the trade payable account, specifically the account of Sally, by $540. The reason we are doing it is because when we are returning goods to Sally, the obligation that we have towards Sally for making the payment is now going down. So Sally would be originally a liability for the business when we have bought inventory on credit from Sally. But now that we are returning items, we no longer owe or have any obligation to Sally. Therefore, liabilities are going down, and when liabilities go down, we debit it. So we are debiting trade payables, specifically the account of Sally, by $540. Now, what's the effect on profit? So first of all, based on the first line, where we debited the account of Sally, liabilities are going down by $540. And liabilities have no relevance to the profit, right? But what about the second line, where we credited the purchase returns by $540? Here we have to understand some things. When we calculate the cost of goods sold as part of our income statement or the statement of financial performance, how do we calculate it? We start with the opening inventory, which is opening stock, and then we add the purchases, then we subtract any returns, and then we subtract the closing stock. So based on the correction which we have just done, where we credited the purchase returns by $540, this means we are increasing our purchase returns or return outwards by $540. That means within this equation, for finding the cost of goods sold, our returns are going up, right? So if our returns are going up by $540, we can clearly see that returns are being subtracted, which means we will end up subtracting more, right? That would result ultimately in a reduction of the cost of goods sold amount by $540, okay? So COGS here refers to cost of goods sold in short. So if cost of goods sold goes down in value, gross profit should go up by 540. Why? Because gross profit is calculated as the difference between the sales and the cost of goods sold. So if cost of goods sold is going down by 540, then gross profit should definitely increase by 540. And if gross profit increases by 540, net profit must increase by 540 because gross profit and net profit are directly relevant or related to each other, right? Because to find the net profit or the profit for the year, we subtract all the other expenses from the gross profit. So if gross profit goes up by 540, then net profit must go up by 540, all right? Now let's look into the fifth error. Motor vehicle expenses of $50 was incorrectly recorded in the motor vehicles account. This is what we classify as an error of principle. And why is that so? This is because expenses have been incorrectly recorded as the purchase of a non-current asset. And the word principle here clearly refers to errors within the fundamentals, where the expense, which is a different category to assets, have been misplaced. So how do we correct this? So we obviously reduce the asset which we have overstated by $50. When assets go down, we credit it. So originally we would have debited it when we overstated it by 50 to reflect an increase in assets, but now that we're correcting it, we know that it has to go down. So therefore we credit the motor vehicles account by $50. Simultaneously, we increase our expenses, which is to debit the motor vehicle expense account by 50. When expenses are incurred, we always debit them. All right. So what's the effect on profit here? So we understand based on the first line, expenses are going up by 50. So if expenses go up, profit must go down by 50 due to the inverse relationship between profit and expenses. What about the second line where we are crediting the motor vehicle by 50? So when we credit the motor vehicle, we are only reducing our asset accounts, and assets have no relevance to calculating the correct profit. Therefore, we don't worry about this. Now let's look into the last error which we have got. An invoice issued of $750 to John for goods sold was incorrectly debited to the sales revenue account and incorrectly credited to the account of John. Now, before we look into our workings, which we have got on the whiteboard on the right-hand side, let's understand some things here. So if we were to read this transaction by ourselves, an invoice of $750 was issued to John for goods sold, how would we have recorded it initially? We would obviously debit trade receivables, specifically the account of John, by $750. We are assuming that we are selling the goods on credit to John. So John is our credit customer. So therefore trade receivables, which are our assets, are going up. And when assets go up, we would debit it. And simultaneously, we would credit the sales revenue account because obviously we would have recognized this as our revenue. So based on these first few words, which I have put within brackets, this is the correct way to record it, right? But the mistake that was made where incorrect recording happened was this. They did the opposite of what we are supposed to do. So let's write the mistake here. So what they ended up doing was to debit the sales by $750 and to credit the account for John by $750. So you can clearly see they have done the exact opposite of what we should have done originally. Therefore, this clearly falls within the criteria of error of complete reversal, where the entire things have been flipped. So how do we correct this? To correct this, we ultimately want to end up with a net balance of $750 for the account of John, all right? And ultimately also want to end up with a net balance of $750 for sales with a credit amount, okay? And for John, we would want a 750 debit. So how can we achieve this? How can we correct this? To do that, we first debit trade receivables, the account of John, by 1500. Why 1500? Because we want to make sure, first of all, the mistake that was made, we first offset the entire amount of credit 750 in the books that we had recorded for John, right? And then once we would have done it, then we would be left with a surplus of 750 here, right? Which would reflect the correct amount, and that would be ultimately a debit balance, okay? So we follow the same thing for the sales revenue account. So if we credit the sales revenue account by 1500, what happens is, first of all, it offsets the entire debit amount of 750 recorded in the sales ledger account. And then the surplus, that would be 750 left behind, would be showed in credit, okay? So we debit the trade receivables account for John specifically by 1500, and then we credit the sales revenue account by 1500. Every time you're working with an error of complete reversal, once you have identified it, it's always that the numbers would be doubled, okay? So what is the effect on profit? So based on the correction we have just done, we understand based on the first line, our assets are increasing by 1500. That has no relevance to profit. But based on the second line, where we credited the sales revenue by 1500, that clearly means our revenue accounts are going up by 1500. And when revenue goes up, our profit goes up by 1500. Okay? All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and also share this video with your friends. And I'll see you in the next lesson.